Hi, welcome to this video today, which is all about best forex trading strategies. And today we're going to be looking at the strategy of George Soros. What made him such a successful trader? He's obviously one of the most successful traders of all time and probably the most famous. Now, there is a lot you can learn from Soros. And he had a big influence on me in the 90s when I read his book, The Alchemy of Finance, his theory of reflexivity. And I was fascinated by his concept of double feedback loops, which changed my view of the market. So in this video, what I want to do is go through his general theory of market movements, how he would look for high odds opportunities, and also his psychology and mindset. So what I want to do is just go through all these points in a little bit more detail, and then when I've finished discussing them, I'm just going to finish up with my favourite top 10 quotes from Soros himself. So right, let's go and take a look at Soros's strategy in more detail. Right, let's have a look at George Soros's views on how forex markets move and how to trade them for profit. That's just a brief introduction to his thinking. I'll do a PDF on this actually with a lot more information. Load it in the member center. Also load it to the free mailing list as well, so anyone can download it. Just click on the link beneath this video and you'll get all our free forex education. Now, in terms of point number one, his views on technical analysis, just basically says that it's of limited use because fundamentals and news are not immediately discounted in price action. Now, that's a basic belief of most technical analysts that all the fundamentals, all the supply and demand facts news will instantly be in the price. So all you got to do is follow price action. Now, Soros's view that it isn't discounted is supported by fact and totally correct. That doesn't mean you can't make money with technical analysis. I'll go through why all the fundamentals and news are not discounted immediately in a moment, but I just want to give his views on fundamental analysis. He's not too keen on that either. He says all traditional economic theories are wrong. The reason he says this is because when you get, let's say, bank research or economists research, they just look at the economic fundamentals, okay, and don't actually take into account the impact of traders. And traders, as we all know, can go a little bit crazy at times and push prices way too far to the upside or way too far to the downside. Now, in terms of both technical analysis and fundamental analysis, he is critical in certain areas. He wants to watch market sentiment. Now, market sentiment, sentiment of traders, that is what creates the price chart from the trader's view of the supply and demand facts. It's trader sentiment that is so important. Okay, now just come to double feedback in a moment, but he maintains market price is generally wrong, and sometimes it can be very wrong. Now, there is an old saying, the market price is always right. Well, it is in terms of that is the price you see, but it's not really help to you when you're trading, is it? The market price, most traders, I think, must believe it's wrong. Otherwise, they wouldn't take a trade either long or short, would they? But there is a time when prices really get distorted in his view, and that's due to double feedback. And basically, it's very simple. Let's say you get a news story and it's bullish for a currency. Traders will impact on the price. By that, I mean they'll go and buy it, yeah? Okay. But then price will impact back to traders, because as soon as the price rises, other traders want to get in on the action. There's a fear of missing out, or they're greedy or whatever. Traders in the market already might want to add to their position. Then the price goes up again, okay? And then what happens when the price goes up further? More traders come in and start looking at the pair and want to buy. Okay, so what you've got is basically traders' impact on price, then the price as it rises impacts back on traders. Now, when you get a news story, it's not immediately going to be discounted in the price, is it? It can't be. Yeah, that simple illustration tells you so. Okay, now obviously what you want to do if you're George Soros or a contrary trader is you want to measure sentiment, work out when that feedback is going to break down. Okay, you want to catch bullish or bearish extremes. The market sold off too far to the downside or it's gone too far to the upside. You can see that obviously on a price chart. When you get those elevated price spikes, they tend to fade, don't they? You don't get elevated price spikes that don't have big retracements at some point. Obviously, you've got to pick where you're going to buy or sell against the herd. Now, in terms of markets that you want to be looking at, or I'm sure George Soros would be looking at, you've got to have high volatility, okay? A lot of volume, okay? You want the story of why a currency is rising or falling to be all over the media. So it's high spec interest. Now what you want to do is look at the news and the price and think, what are traders anticipating? Okay, because very often they'll anticipate things which are not based on fact. It's kind of like a story or an assumption. Let me just give an example. Did a video just before this one. It's on the British pound against the USD, and British pound got sold off really hard by traders. Okay, came in saying there'll probably be a hard Brexit. Okay, then the stories get even more exaggerated in the media. There's going to be riots in the street, food shortages, aircraft grounded, economy is going to go downhill, completely doom and gloom, and traders just come in and sell. And the more the pound sells off, the more the media hype gets worse. So what are traders anticipating? And we were thinking this when we wanted to buy the British pound. They've already decided there's going to be a hard Brexit and the UK economy is going to collapse. So if that doesn't happen, prices are probably going to rebound. And if you stood back and ignored the media frenzy, negotiations were going on between the EU and the UK, and there was no reason to take such a completely bearish view, and everyone was anticipating a bad result. It doesn't take much to turn it round, and now the British pound has rallied a good few hundred pips, I think about 400 or 500 pips from the low. When everyone has gone one way, it doesn't take much to turn it around, because what you have is the people who are in late will tend to have very close stops. So when it turns, the stops get rolled and they keep getting rolled, and the price basically fades back. Okay, now in terms of this, your aim is obviously to look and see when the bullish or bearish fundamentals are going to peak. How exaggerated is the story, and then look at price action. There's many different ways of doing this. We cover many ways in our in our videos, and I'll do some in the PDF as well. But we'll look for a slow up in price, a reversal candle. We'll study volatility, deviation of price, how far it is away from a mean price, like a 20-day moving average. Many different ways of doing it. But you must have confirmation. And basically, when you trade against the herd, you just use a very tight stop, okay? Because, you are trading against a crowd who might be stupid, but they're very powerful. So you want to take a small loss if you're wrong. But if you're right, generally you'll get a big move in your favor. And on trades like this, you can generate risk to rewards of easily 3 to 1, 5 to 1, sometimes even more. Okay, so you don't need to get many trades right. Also, when you understand the basic concept of feedback loops, and you realise how unpredictable traders are, you don't mind being stopped out, because you know eventually those feedback loops will break down, okay? So you can come back and have another go. So it's a great way of trading, okay? I'll give more insight into how it can be done with various different techniques. I'm obviously just going through it in general terms here, but a fantastic way of trading. Now, in terms of George Soros, his hit rate in terms of the amount of trades he won was worse than random. And Stanley Druckenmiller, another famous trader who was with George Soros at the Quantum Fund, said he was really surprised at how few trades Soros got right. But obviously he's winning far more on his winners than he's losing on his losers. And also Druckenmiller said he was the best loss taker that he'd ever seen. So when Soros took a loss, he was just totally confident in his ability to get the money back. He never worried about taking the loss. He's wrong. He's wrong. He knows he cannot predict human behavior. Okay, just trade in probabilities. So no problem in taking the loss, walk away, and then he can come back. I mean, he was supremely confident that he would get the money back. Okay, I think a lot of traders, when they trade, don't trade with total confidence. Like when they're in a trade, they don't accept the result. Okay, you've got to accept the result, good or bad. You know where you're wrong. That's it. You can come back and do the trade again. Okay, doesn't matter. But it's a sign of confidence. Yeah, I think anyone who is a professional trader takes losses very cheerfully and doesn't mind taking them because they know they're going to get them back. They know their strategy's got an edge and they know the trading probabilities, and that's exactly what Soros did. Now, in terms of trading frequently, did he trade frequently? No. Like many great traders, he stressed, you've got to be patient. You've got to wait for the right opportunities. You shouldn't be trading all the time. So he'd wait a long time for the right opportunity, but when the opportunity came along, he'd really go for it. And I see a lot of people online, and a lot of people ask us this as well. It's like, how many pips profit can you make trading, let's say, every month or every 3 months, whatever it is, what's realistic? Pip profits don't mean anything, do they? It's how much money you've got on the trade. That is how much are you risking. Now, in terms of George Soros, he was all for risking a lot. If you had the high conviction trade, you very often might only have one trade on. Like, for example, the trade that broke the Bank of England, okay, netted him $1 billion. He just didn't believe in diversifying and spreading his risk. He wanted to hit hard, okay? So you're patient, you wait for the high odds opportunities, and then you really go for them. And that's, basically how Soros made his money. In terms of his analysis, I mean, he studied sentiment. Anyone can study sentiment, okay? I've got plenty of videos on how to do it. Was he watching price all day? No, he actually only had one quote screen, okay? And he hardly ever watched that, he said. You do see a lot of people online, probably got 5 or 10 quote screens around them. That's just show. There's hardly any professional traders who would bother doing that. You don't need to. If you're hitting big moves and you're trading a longer term move, Soros's moves might take, sometimes they could take days to come to fruition, or weeks, sometimes months. You don't need to be price watching. A lot of traders get obsessed with it. The more you watch the price, the more you get emotionally involved. So you stay away, like Soros would do. He knows where he's wrong, okay? That's it, he's out. Doesn't need to watch the price, okay? How simple was his strategy? Were there any complicated mathematical equations? No, not really. Like he said, if you make a strategy too complicated, it's just going to have too many elements to break. Simple is best. And a lot of people think, I heard someone the other day who was saying to me that Soros was a mathematical genius. No, he wasn't. Not at all. Mathematics never really featured to a big degree in his trading strategy. Okay, he did keep things very simple. And yeah, I think in terms of George Soros, I've only just given a brief introduction really here. But he's a great trader to study in my view. I do actually, I'm sure regular viewers know, I just love going for bullish or bearish extremes when the market is really looking for the price just to carry on forever. They are just the best trades, in my view, to catch. I mean, there's a certain satisfaction about catching them, but your risk is so small against your reward. So you don't actually have to risk much money to make a lot. Okay, a lot of people think you need to risk a lot to make a lot. If you get skewed odds trades, and I said this in a video about Paul Tudor Jones the other day, you can make a lot of money and your risk can be very manageable. Right, that is the video for today.